In this presentation, we will create an invoice and discuss the impact on the financial statements, the balance sheet, and the income statement or profit and loss within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. We will be entering an invoice. The item of an invoice is pretty self-explanatory. We'll take a look at it, however, in a few different areas so we know what our objectives are. One, if we select this plus item up top, we're going to the customers and we will create an invoice. Why? Because it's a bill. We're going to create a bill. We either did work, a service, or we had sold inventory and therefore want to bill the client and expect to receive payment at some point in the future, as opposed to something if we were at like a cash register right now where we would sell a sales receipt, which means that we're going to get payment at the same point in time. Before we go into the invoice, let's take a look at the financial statements and get some concept, some idea of what will be recorded, because note now, everything we record here will typically be affecting the financial statements in some way, the balance sheet, the income statement, the profit and loss. It's good to keep in mind what that effect will be. It'll give us a better idea of what is happening, what is going on, how to set up this information, how to think about what we have set up is working in order to record the information. So let's first go to the reports on the left side. We're going to go to the standard reports. We want to take a look at that balance sheet. So we'll open up the balance sheet and we are going to change the dates once again to 01/01/19, 12/31/19. That's January 1st to December 31st, 2019. Run that report. What's the goal of the invoice on the financial statements is, one, we're going to say that accounts receivable goes up. That's what the invoice is doing. It says someone owes us money. So one thing that's going to happen is the accounts receivable will go up. The other thing that's going to happen is inventory is going to go down because we sold inventory. So the inventory is going to go down. Those are two of the main effects on the balance sheet. We'll also discuss sales tax, but I don't want to get too ahead of myself on that. We'll discuss the sales tax. It's kind of like a tweak in the process because the taxes always complicate things. So we'll talk about that more next time or once we record the invoice. Now let's go back to the reports and think of the other side that's going to be affected. That being the profit and loss. Profit and loss. Let's change the date back to 2018 just so we have some information in the profit and loss. So we're going to say 01/01/18 to 12/31/18, January through December 2018. Run that report. Note what's on the profit and loss is income and expenses. And what's going to happen when we have an invoice, income's going to go up. Why? Because even though we haven't got money yet, we invoiced the client, we did the work, we delivered the goods, or we did the service and therefore earned the income. So income's going to go up with an invoice, and also cost of goods sold, the relation of the inventory we're giving away if selling inventory will go up as well. The net effect, income going up, and the cost of goods sold, the sale, the expense going up, the net effect being the subtraction between the two, the effect on net income or gross profit. So let's record an invoice and we'll come back and see what will happen. Keep that effect in mind, or at least in the back of your mind as we enter this. We're going to go to the plus item up top. We're going to go to the invoice. Note that as we enter the invoice, most people don't need to know all that information. However, when setting up the QuickBooks file, we need to know it to set up the invoice, to set up the information for the invoice, to make the data input easy, and to be able to interpret what's going to happen on the financial statements and therefore read the financial statements. We need to have some idea of that as well. So we're going to first start off with the customer name, and we're going to add a new customer. Actually, this customer's here already, Anderson Guitars. So as we type in Anderson, it'll populate for us. That's the one we want, Anderson Guitars. We're not going to add the email address. The billing address will be the same. We don't have any other information in terms of the billing address, just the name. That's how we will keep it. The terms is going to be when they're going to owe us. So net 30 means this is the date of the invoice. Then 30 days is when we expect payment. If we're not paid within 30 days, it's past due. We may take some other action, or we're concerned at that point, maybe looking for collection action at that time. So then we have the invoice date we're going to say is on the 12th of January 2019, the year we are working on. The due date when this will be due is going to be on February 11th, and that's going to be calculated by QuickBooks because it's the 30 days after the invoice date. If we needed specific shipping information, we can add the shipping information. We will not be adding anything in that field at this time. We're going to continue down to the product or service, so we'll enter the product or service that was sold. We're going to say that this was a guitar, so it will be a product. We're going to scroll all the way to the bottom and say that it will be this Steinberger solid body. So that will be a type of guitar that we are selling. We're going to select that. That's going to give us the product ID, the product service ID, the description, the quantity, the rate. Note once again that this is going to be given to us by the products and services, the items, the inventory items that we set up. Once that's done, notice how easy this is to fill in, how easy it is to fill in the invoice. We don't need to know anything about the input of the product or service, or the product in this case, and we don't need to know what the effect is on the financial statements. However, to set up the items, we do. To set up the data input easily, we do. To understand the financial statements, we do. It will be taxable, so we have the tax information as here with the check mark. If we click down here, it will then add the tax. It's calculating the tax for us. So there's the 410, there's the tax. This is a practice problem, so we just want to make this 5% as a generic tax, a generic sales tax. Therefore, we're going to select this sales tax item. We're going to override the sales tax. We're going to put it in there at 5%, which is $20.50, $20.50. And then we're going to say the reason is other, and confirm the override and close. And there we have it. So that's what we have. Now, if we think about this, when we record this, we're just going to send out this invoice. That's all we're going to do. We can email it, we can print it, we can give it as a PDF file, or we can send it. However, it's also going to make a transaction on the financial statements, and what will that transaction be? Well, we know that this is going to be an invoice, and that means the invoice itself is the form that's controlling accounts receivable. The fact that it is an invoice means that accounts receivable, people owing us money, will go up. The account representing people owing us money. It will go up by the full amount owed, including the sales tax, so the $430.50, the full amount of the sales price and the sales tax. That's what we are charging. That's the check we expect to see at some point in the future from the customer as they receive this invoice within 30-day time period. The other thing that's going to happen is sales is going to go up. Sales is going to go up, but sales is only going to go up by the sales price, the $410. That's the only piece that we get to keep. The $20 will not. So we've got accounts receivable going up by the $430, sales, revenue, income statement account going up by $410. The difference of the $20.50 is something we don't get to keep, and therefore something that we collected, don't get to keep. We owe it to someone in the future, a liability account, a liability to sales tax payable or some type of payable typically that we'll then have to pay to the government, whichever government is charging us sales tax. In this case, we're saying it is New York, the state of New York. The next thing we're going to have here is that we're sold inventory. Inventory is going to have to go down then because we sold it. Now, the inventory going down is not going to go down by any number on this sheet. It's going to go down by whatever we put into the Steinberger item, the cost of the item. So note that this journal entry is going to record a transaction with numbers that aren't even on the invoice, because of course we do not want to include the cost of the guitar on the invoice. We just want to include the sales price. However, we would like the invoice to drive the cost. So just note, whenever we buy anything at a store, typically the cashier, if their job is just to be a cashier, they don't know what the cost is to the store. Possibly they may not have that information. They don't need it. All they need to know is the system is then telling them what the sales price is, and the system will record the cost if it's sophisticated enough to do that, if we're using a perpetual system. So the cost of goods sold will bring inventory down by the cost, and then it will also record the related expense, the cost of goods sold. All of that's being recorded by this very simple form, this invoice. If we scroll down, we have the similar options as we have with the other forms. We can print the form and we can send it as an email. We here are just going to save and close at this time. So we're going to say save and close. Now we'll go to the reports and see what happens. So if we go to the reports on the left side, we're going to open up that favorite report once again, that balance sheet report. We're going to change the dates up top to 01/01/19 to 12/31/19, the year that we are working on, and we will run that report. So here we are on the balance sheet. Now let's consider the effect on the balance sheet. Now first off, the checking account isn't affected. Cash isn't affected. We didn't get cash. We basically, you can imagine us sending the invoice out. We expect to receive a check in the mail. That account, the check in the mail account, we expect to receive a check in the mail account, is accounts receivable. So accounts receivable is the account representing people owing us money. If we then select that, going from the end result back to the forms, we see then our invoice. Here is our invoice, Anderson Guitars. If we select that item for Anderson Guitars, then we go into the invoice that we have seen. If we wanted to update or edit the invoice, we can do so in that fashion. We'll then close this back out. And what's the other side? I'm going to go back up. And I'm going to go now to the other side, which is on the income statement of the accounts receivable. That's typically how you would think of the journal entry. The account related to accounts receivable on the income statement or profit and loss is called sales or income or revenue. I'm going to do a little bit of a trick here to try to get two screens open so we can bounce back and forth between the financial statements. What we're going to do is go to the top and select this tab, right-click on this tab, and simply duplicate this tab. So I'm going to duplicate this tab so that now we have two tabs up top with QuickBooks in it. This one's going to have the balance sheet. I hope to go to this side and have the income statement. Actually, I'll reverse that. This one has the balance sheet name up top. So I'm going to pull this tab to the right of it, and then I'm going to use this one to create the income statement. So let's do that. We're going to go to the reports now on the left. If you can't do this two-tab thing, that's okay. You can just go back and forth between the balance sheet and the income statement, or profit and loss, as it's called in QuickBooks. Now we're going to go to the profit and loss, our other favorite report. We're going to go up top and put in the date range of 01/01/19 to 12/31/19, January through December 2019, and run that report. Here we have it. The sales up top, there's the 410. The sales 410. Note that if we go back to the balance sheet, then the accounts receivable, if I go back into that detailed report, was for 430, not 410. So if I go back to the income statement then, profit and loss, other tab, income statement, why is this 410? Let's click on it. Here's our invoice. If we select that item, remember that people owe us the full amount of 430, including the sales tax, but we only earned 410. The other amount is supposedly just not part of the sales. It's part of what the government's going to get in terms of our transaction. So that's going to be the $20. So we only get to record revenue of 410. So I'm going to close this back out, and we'll go back to our report. What's the difference then? Sales tax. Where's that going to go? That's back on the balance sheet. So if we go back to the balance sheet, sales tax, where is that recorded? Where's that $20 and so much? Back to the reports, that's going to be a liability because we owe it to somebody. So we'll scroll down. In our case, it's owed to the New York Department of Taxation. It's owed to whoever we owe to. So it actually is giving a line item. It would be kind of nice if it just said here that it was sales tax payable. That's what it really is. This right here is the vendor who we owe to. But it's being more specific in the balance sheet. It's telling us this is who you're going to owe to. If you're in another state or another country, then you're going to have, whoever you owe to, QuickBooks is going to put that there. It's trying to be very specific about this information so that it can track it very specifically, taxes being a bit more complicated to work with. So if we click on that $20.50, we're going to see that invoice once again. So here is going to be our invoice for the Anderson. If we select it, then we see that $20.50 is broken out down here in the sales tax. Now it's got two different levels because of, I believe that's the way New York works. I actually don't live in New York, so New York has very complicated taxes. It's probably the most complicated, or one of them. So we're going to scroll back up and we're going to go back to the report summary. So we're back to the balance sheet. Now the next thing that happens with this invoice is that inventory must have gone down, because that's why we have the invoice. We gave inventory And at that point in time, when we earned it, we're going to decrease inventory. Here's the inventory account. If we select inventory, we should find this again. Here is our invoice. Now note here, this is what's funny. There's a decrease in inventory of $328, and it's due to this invoice. That's the form that's driving it. But when we select the form, we don't see that amount on it, so it's not there. Why? Because we don't want the cost on here. We don't want the cost of what we purchased the inventory for. How does QuickBooks know what it is then? How would we know how that number came about? Well, we're going to have to go back then. We're going to close this back out. And to do that, we would have to go back to the sales items and then go to the products and services and say, well, what did we sell? The Steinberger hollow body. So this one down here. So there's the sales price. But if we go to edit, then we can then see how much we paid for it. So we can scroll down and we can say, oh yeah, there's the $328. That's what it cost. So note, most people won't do that. Most people don't know that when they enter the invoice because they're just doing the data input. But the invoice has to be set up that way. We need to know how it's set up, and we need to know what that setup is important for so that we know how it's going to affect the financial statements, create and fix any problems when they so appear, when they arise. The other side of that then will be on the income statement. So if we go back to the other tab where our profit and loss is, it's going to be the cost of goods sold. There's that 328 again. So notice there's multiple accounts here that are balancing out. It's not just 2 accounts that are recorded from this invoice. We have 5 accounts, but they're an equal number of debits or credits or increases or decreases. However, there's a balancing, however you want to think about that. If we go to the cost of goods sold, you'll see that we have that cost of goods sold here as well. So I'm going to close this back out. We're going to go back to the reports. And last thing we want to look at is going to be the accounts receivable by customer, just so we can see how that tracks as well. So if we go to the reports on the left side and then scroll down, we're going to say who owes you. We want to say who owes us money. And we want to do the accounts receivable detail report. Here's the accounts receivable detail, who owes us money. We'll select that item, and that's as of a current date, so it's as of today, and we will see within there we have our $430.50 from this invoice that increases the amount that Anderson owes us. And we can see that the total amount owed to us is $20,930. If we go back to the balance sheet, remember that this has to tie out. This is a supporting document to the balance sheet, so let's go to reports. Let's go to the balance sheet, change the dates up top once again to 01/01/19 to 12/31/19 and run that report. Just recall that this accounts receivable, $20,930, back to our accounts receivable report, matches the total here, and now it's broken out not by date, not by transaction detail, not by a general ledger, but by customer, who owes us the money, including the invoice that we just created, the $430.50, which we expect to receive in the mail within 30 days in accordance with the terms of that invoice. For more accounting information and accounting courses, visit our website at accountinginstruction.info.